You ready?
Okay.
My name is Eric Hartley.
And I'm Phoenix Talent. We're doing the consumer sector.
So this is the S&P 500 weightings, how they're supposed to be weighted. As you can see, with consumer discretionary, we're at 10.29, and consumer staples is 6.7. SIF is under in consumer discretionary and over in consumer staples. And these are the performance charts for the last 5 years. As you can see, discretionary has been consistently going up, and staples has underperformed in relation to the S&P 500.
So for consumer discretionary, this is just kind of everything that it entails. Consumer discretionary, for definition, is goods and services that are considered non-essential by consumers but desirable if available if income is sufficient. So if you look into this, a lot of it is basically it's discretionary, you can choose whether or not to go out and buy these things. This right here is what we hold currently in our SIF portfolio. This is for clothing, working out, hotel, boats, so it's all consumer based. And then some notable companies, I did the textile for specifically footwear and accessories. So for this, I did the most notable in footwear, and that Steve Madden has some other things as well, so does Fossil. But right here, this was their market cap at as of this morning. Nike is by far the most. And so consumer discretionary is very strongly correlated to the economy. So this blue line right here is consumer discretionary. This light blue one is the S&P. They are very much consumer discretionary holds above the S&P, but they are very much they dip in the same places and peak in the same places, which means that it's a cyclical industry. And they said that the best time to invest is during the recovery and early periods. So when we're coming out of a recession and there's room for growth, that's when people start buying discretionary things again. Some metrics involved in consumer discretionary would be gross margins. So is their costs covering, or are they making enough revenue to cover their costs to sell the things? And profit margin is how much sales correlate with the profit. Inventory turnover is, just how quickly are you selling your inventory? Are you making a profit off of it? Same store sales, which compares different stores selling the same things in different places. Stores under a year are excluded just because, the first year isn't a good basis to go off of. And then price to book multiples is useful for evaluating different companies. Economic indicators, interest rates, so the higher the interest rate, the lower that consumers are going to be spending. Wage growth, so how much the consumers are making, are they able to go out and spend money on things that they don't necessarily need. Unemployment rates is, so obviously the lower the unemployment rate, the more money that they have to spend, because they're employed. Consumer price index, and then consumer confidence index, which is it's a survey that basically measures their intentions on going out and buying things in correlation to the economy. Profit drivers, a lot of it is obviously consumer oriented, so basically quality, how are the quality of products, are consumers going to want to keep buying it? The environment of the different stores and the employees that work there, or even online. Is it easy to maneuver the website? Are people going to want to come back to the website? Inventory turnover, economic growth, gross margin, industry comparison, the prices. And then for trends, I did a pestle, and the most notable were probably, for political right now, there's obviously a trade war with China. And a lot of things like cotton silk, there's tariffs on them. So, that's obviously gonna affect textiles as a whole. Social e-commerce is a lot more preferred now just because it's easier to get stuff online than having to go out and buy stuff all the time. Well, like going to stores and buying them. And then for technological, there's a lot more like 3D printers, vending machines, things that are coming available for producing all of these at a faster rate, get more inventory out. And then also we have organic products are becoming more and more popular because, everyone's about saving the world and going green. And then for competition, the threat of entry is pretty low. I mean, you mainly just need to have a good investment in the product that you're trying to sell. And then there's also, some licenses that come with that. Rivalry, we have counterfeit products. So, I don't know, like someone trying to sell Gucci purses on the street instead of like real purses. And then e-commerce, I would say is Rivalry, just like, companies that sell just electronically on the line. And the buyers, they have a strong power due to the large industry. So, yeah, basically they can like, what's the right word for it? Like, they get to negotiate prices that they buy.
So who do you consider the buyers in this instance?
Like Walmart or someone
Okay,
going
so
to like
big
Clorox.
retailers.
Yeah.
Okay.
And then suppliers, I said that they had a mix of high and low power, just because depending on who you go to, obviously, you can, I don't, like the cost incurred by switching suppliers is very different. And then when you have things like exploitation, when, people over in China working for lower than living wages, and that's obviously going to affect it. And then substitutes, I have small local stores, so basically small stores that sell the same exact thing as big industries, but they have more of like, people would rather go to them because they know them, or it's a, small town, things like that. And then,
So I did consumer staples, food and staples retailing. And so basically breaking down the different groups in consumer staples, we got food and staples retailing, food, beverage, and tobacco, household and personal products. And then we have some holdings. Obviously, we were overweighted in this sector, so we've got quite a bit. I think we have to do, what is it? What is the new store that just came? Costco. We have to do a Costco analysis due Thursday. So this is the industry sector for that. We got Kroger, Walmart, CVS, Costco, Anheuser, if you remember the Bloomberg Homework Summit did a couple weeks ago, and then Goodyear Tire. Next slide. Just walk.
yeah.
So we just have some of the big food and staples retailing stores. These are going to be companies we're all familiar with. If you've gone anywhere in the United States, you've seen one of these. This is a chart pulled from the 2008 recession. And if you look, food and staples retailing it outperforms the S&P as a whole. It doesn't necessarily go up, it just holds constant because food and staples retailing are the items and products that you're going to buy even if you have no discretionary income. These are going to perform well in the late phase and the recession phase of the business cycle. But by that, and for a fund like this where we can't divest into things like bonds, shifting funds into these companies is going to be more stable than if we just let them run on the market. If you're invested in consumer staples or consumer discretionary, you're going to lose a fair amount of money at some point in the cycle. So some key metrics that we have for this industry is inventory turnover, ROI and ROA, consolidated results of operations, peer performance, distribution costs as a percent of revenue, free cash flow, net profit margins, and profit generated as a percent of revenue. Some economic indicators are going to be when companies start ordering for plants and equipment, or lack thereof, because we're looking for the market downturn as a whole, and when people stop investing and there are no new housing starts and there is a increase in raw material prices or profits start going down, we're going to start looking at this sector to offload some of our investments. But these are just loose indicators, obviously we can't predict when the next recession is. We have some lagging figures like the interest rate, unemployment rate increasing or decreasing, a wage increase or decrease, and then coincidental figures are going to be GDP and the unemployment rate. So we have some profit drivers. This is we're retailing to your average consumer, so we want to have our fixed costs low, our variable costs as low as we possibly can. Price needs to be above those so that we're making a profit. Cost of debt, inventory, sales volume, and then we have our non-financial drivers, which are productivity and client satisfaction, training of employees, morale, business culture and values, market share, and then just basic things that companies are going to look at when they want to invest. We have some trends in this industry, like legislation on what you actually can and cannot sell. If you guys are familiar with the e-cigarette industry, they just got shut down on what they can actually be, or where they can be sold in stores, and that's going to impact this business model because I can't sell certain things that I might have made a high profit on. You're also going to see with companies like Apple, they're going to have their own internal rules and regulations where they set a price and you might not make as much profit if you're selling specifically those products. So for the social, we're seeing a shift to e-commerce, and people are looking for different options. They might not be as likely to go spend money at Walmart. They might want to go to a smaller store, and we'll get to competition in the next slide. As far as technological trends, we've got self-serve stores cropping up. You guys are familiar with Amazon's self-serve market where you walk in, you walk out, and that's going to be a huge threat for this industry, and it's going to change the way that things are distributed monetarily in the stock market. And then ecologically, there's a big push for sustainability and eco-friendliness. You can be banned or blackmailed by your consumer if you're supporting a company that doesn't support the environment. And then we have obviously your legal or legislative restrictions like sales taxes. So for the Porter's Five Forces, I determined that the threat of entry was low. It's not unheard of for small grocery stores to pop up, but they're unable to achieve the same scale or supply chain, and they really don't have much power when they go, and a buyer can go to a small store and they may be likely to go into Fred's just because they can get it for $5 cheaper. Bargaining power of buyers is relatively high. They have little switching costs. They can hop from Fred Meyer to Walmart. They're 10 minutes from one another. They can go online, and a lot of the products that they're selling in the stores are undifferentiated, and so there's no reason that I would pay more money in one store than another, and they really have to watch what they're doing. Obviously, we have a high existing rivalry, and that leads to a moderate amount of suppliers. We've got Fred's, Walmart, Costco, and then you can substitute food for one another, And then if I'm distributing one of the consumer staples, such as like razors, I can go to different stores and I can pick out what I want. And I don't have to buy your razor specifically, especially if it's overpriced. And then bargaining power suppliers is going to be moderate. There's relatively few suppliers from what I was looking at, but these stores are so huge that they can dictate the cost of their price. They can demand or command a lower price of product, and they can't afford to lose it. So there is a little bit of bargaining power on the supplier end. And that's it.
So some of the metrics you guys identified, or some of the profit drivers you identified are pretty vague or broad, which is okay because you have a sector that's comprises a lot of different industries, but some of them are more specific, like Phoenix, you talked about like same-store sales growth. But if I were looking at, say, a Nike, they certainly have stores, so that's a factor we could gauge them on, but most of their sales are probably not in dedicated Nike stores, they're probably through other channels, so that may not be the best metric to think about for a company that's primarily a manufacturer, like a maker of things, as opposed to like owning your own physical retail locations. So I think about that. I thought, Eric, like your list of metrics, perfectly fine, but also probably broadly applicable to just about almost any industry in this room. That's not a bad thing, just think about that. I'd also, this is not a knock on your guys' presentation, but just something to know. We have sold Kroger. It was on the holding statement, but it has been removed. So we're not probably at this point overweight on staples. So just think about that in terms of portfolio balance. Kroger was something that we voted on selling last semester, and I sold it in January, but I sold it on the last day of the month. So it somehow eked its way onto the holding statement. Okay. Okay, thank you guys.